Guys, on Friday, the stock market had a big fall with the Nasdaq falling over 2%. The tech-heavy Nasdaq, led by the Magnificent Seven, down over 2%. And it's continuing that slide today. We're early in the trading, but right now the Nasdaq is down over 0.6%. And this is what led it all. U.S. consumer confidence falls back on fears of tariff-induced price increases. Now, guys, if you've watched our channel before, you know that we've talked about tariffs and said, guys, they're just inflationary. When you increase the cost that it costs to make a good or service, prices are going to go up. That's inflationary. It's a very simple thing to understand, but for some reason, people look at it as a positive. If you look right here, inflation expectations jumped to 4.3% this month from 3.3% in January, the highest reading since 2023. Now, that's not going back very far, but remember, 2022, we had the big inflation, so it was kind of an issue for all of us as a country, and that's what sparked a lot of fear in people. Now, guys, you look right here, the University of Michigan Go Blue Index of Consumer Sentiment tumbled to 64.7 at the end of February, well below January 71.7, also weaker than the economist's expectations of 67.8 from a Wall Street Journal poll. Now, guys, this is the history of Consumer Sentiment Index. These areas in dark gray are recessions. If you look right here, there was no recession here, and we have not called a recession yet here. Now, remember, people look at consumer sentiment and say that could be a leading indicator for a recession. And the reason being is consumer sentiment is how do people feel about their personal financial situation and the economy? It makes sense. If people are feeling crappy about it, are they more likely to spend more money or spend less money? Now, of course, they're more likely to spend more money if they feel good. I'm looking at this going, isn't it interesting that people started spending less money during recessions? Why? Because once the recessions occurred, remember, these are always called after the fact. Recessions are not called usually during them, but usually after the fact. People then feel a recession, and then they start spending less. But we get out of the recession, we rebound, we get better. I personally believe that consumer sentiment is a lagging indicator. What I mean by that is it happens after the fact. But that's a bit counterintuitive because if you think about it, if people feel crappy about the economy today, they're less likely to spend in the future, which could then drag down the economy. Because remember, 68 or 70% of the US GDP is driven by consumer spending, which is a very high percentage. And here's what's interesting. Weaker confidence was unanimous across groups by age, income, and wealth. So it didn't matter how old you were, how much money you made, how much wealth you had. Unanimously, people were more concerned. But no shocker here. While sentiment fell for both Democrats and independents, it was unchanged for Republicans. Why? Republicans have their president in office. And I do believe that cracking down on the U.S. government and sitting there and saying we need to spend less is a great thing, but don't think that's not going to come with short-term hurdles along the way. Now, we're printing a lot of money. When you print a lot of money, there's expectations for inflation. Maybe that's part of the reason why this jump happened. But guys, the biggest concern for me, out of everything we do here, and you might sit there and say, well, Paul, if the economy does poorly, what's going to happen to the stock market? Probably not very high, not very good. And here's also why. Every week, I update our stock market to GDP ratio as well as our 10-year cyclically adjusted PE ratio. For those who are new to it, the stock market GDP ratio is considered the Buffett Indicator because he talks about how it's the most reliable metric at any given time of where stocks fall because it's the entire stock market relative to GDP. And it makes sense. If GDP goes up, the value of the stocks, companies within that GDP should also go up. The 10-year PE ratio takes the last 10 years of earnings, brings it to today. That way it gets rid of the highs and lows and the extremes and says, okay, what is it relative today in today's dollars? Brings it with inflation. What does it look like? Stock market GDP ratio fell last week. Why? Because the market fell last week, but it's still 113% overvalued. Overvalued. Historical average ratio is like 0.92 or 0.95, and we're at 2.02. That's massive overvaluation. Now, the 10-year PE is currently at 37.9, 38. Historical average is 17. Now, I love seeing the comments that people have made and said, the second you talked about stock market GDP or valuations, I stopped listening. Bingo. We need that kind of, we don't care about valuations. It can happen for a long time. that's what has bubble-like tendencies. And I think in this stock market, we are in a bubble. Why? You see things like crypto and Bitcoin, which I think has no intrinsic value, and you hear people defending it because it's going to change the world and nothing has intrinsic value. These kind of things just feel very bubblicious. When you have the largest companies in the US stock market selling for nosebleed valuations, that only assumes perfection. Now, guys, one of the biggest companies in this economy that I was talking about is Nvidia. Wednesday, they report. And follow this channel to make sure you see our recap. Remember, I look at these earnings as kind of a guide. Are they still on the path? I don't make these massive decisions based on quarter-to-quarter results. We're here to teach a principle-driven investing process. If you're looking for a channel that'll just tell you, go buy a stock, go buy this stock and make a lot of money, we're not the channel for you. We're looking for people who want to get better. We're looking for people who want to learn. This is really, really important because if we teach you how to fish, you're going to be able to do this nonstop and you'll sleep better at night. And that's really what's important. Because if you look what's going on out there in the YouTube world for finance, these people have no clue what's going on. But if you have the right process, you can apply it to your own investments. Whether we understand it or not, that doesn't matter. If you look at all these value investors out there, they believe in different companies for different reasons. But you tend to find the same principle-driven investing kind of idea. And remember, guys, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is what's popular in the short run will go up, what's not popular will go down. But in the long run, what's going to drive stock prices? Earnings. As the company, you're buying a piece of a business. As that goes up and up and up, as the earnings go up and up and up, the value of the business will go up. As long as you pay a reasonable price today. So if that makes sense to you and you want to surround yourself by principle-driven investors that you can learn from and also help, and if you want the tools to make better investing decisions to help you sleep better at night, join our community. Everythingmoney.com/sign up. You can try it out. I'm not asking you to make a lifelong decision. I'm asking you to make a short-term informed decision to help you get better at investing. Click the link in the description below, and I assure you it's the best investing decision you'll make in your life. Thank you for your time.